Welcome. Ever wondered why smart, rational people panic sell during market downturns? It's a common, costly trap. Today, we're diving into the emotional psychology behind panic selling and providing strategies to help you stay disciplined when the market gets volatile. The first step is acknowledging market volatility. The stock market moves in cycles. Downturns are a normal, inevitable part of the investment landscape. The paradox is seeing highly intelligent people who understand financial fundamentals make irrational, emotion-driven decisions like panic selling. Let's explore the core psychological drivers that trigger this behavior. Loss aversion is powerful. Studies show the pain of loss is twice as strong as the pleasure of an equivalent gain, driving investors to sell simply to stop the emotional bleeding. Recency bias causes us to overemphasize recent, often negative, news and market events, making us believe the current downturn is a permanent collapse, rather than a temporary dip. When everyone around you is selling, the urge to follow the herd becomes overwhelming. This herding behavior is a survival instinct, but in the market, it often leads to buying high and selling low. These aren't the only mental shortcuts working against you. Other cognitive biases amplify panic selling. Confirmation bias leads you to only seek out information that justifies your decision to sell, ignoring data that suggests holding firm or even buying more. Anchoring is focusing obsessively on the stock's peak price. When the price drops, you feel the loss more acutely, rather than focusing on the investment's long-term potential or current fundamentals. So how do you combat these powerful psychological forces and invest rationally? The most effective defense is having a well-thought-out, long-term investment plan and committing to stick to it, regardless of short-term market noise. Automating your investments, such as through regular contributions, removes the emotional decision-making process during market highs and lows. During a downturn, instead of panicking, revisit your original investment thesis. Have the company's fundamentals truly changed, or is this just market turbulence? Let's summarize the key takeaways for overcoming market emotion. Overcoming the emotional traps of loss aversion and herding behavior is the single most important factor for long-term investment success. Be rational, be disciplined, and remember that time in the market beats timing the market. Thanks for watching.